How would you describe your dream industry? I'd often hear things like recession-resistant, recurring revenue, not capital-intensive, and growing demand, and all of that pretty accurately describes the senior care business. Senior care is on fire. With an aging population and a shifting desire to age at home, it's one of the hottest categories in franchising today as we head into 2026. And in this video, I'm going to give you 5 reasons why you should consider senior care as the industry in which you build your franchise empire. And if it's your first time here, welcome. I'm Connor Gross. I'm a franchise owner and a franchise consultant who loves helping people find the right franchise for you. So for access to my library of franchise breakdowns and more free resources, you can click the link in the description. The first reason to consider investing in a senior care franchise is the market shift that's happening in senior care and how this is creating opportunity for a lot of home care franchises. Because whenever you look at an industry, it's always important not just to look at the top line and not just to look at is it growing or shrinking. Obviously that's important. You'd like to be in a growing industry, but you also need to look under the hood and look at the shifts that are happening in this industry. And ideally, if you're evaluating a business model, you want to get into a business model where any shifting is tilting in your advantage rather than to your disadvantage, even if the industry is growing at large. There are 3 main forces that are creating a massive opportunity in the home care industry right now. And force number 1 is COVID. So during COVID, families watched as their loved ones were in nursing homes. They were isolated. A lot of times they were unable to visit during the pandemic. And obviously there were a lot of tragic outcomes that got very extensive media coverage. And so what you've seen is a permanent shift in consumer psychology around nursing homes to where the default thinking has changed from, well, we'll put mom in a facility to we need to keep her at home. We need to bring in home caregivers to care for her when the need arises. And the second force is what I call the 2% mortgage locked-in effect. A lot of seniors have these fixed rate mortgages. If they still have a mortgage at all, they have fixed rate mortgages from when rates were near zero. So they may be sitting on 2% mortgages with $1,200 a month payments. Well, a nursing facility on the low end is going to cost $4,000 to $6,000. And again, that's on the low end. They can go much higher than that. The math has changed to where a lot of seniors are in a position they can look at keeping their house, paying for in-home care. They come out ahead financially and they're in an environment where they're more comfortable and they're choosing to go that route. And so the housing market economics are tilting heavily towards aging in place as well. And that brings to force number 3, and that's that real estate development is also accelerating this because obviously in the US we have a housing shortage. The demand for housing is increasing rapidly relative to the supply and it's already out of whack. And so whenever that happens, capital allocation and how people allocate both investments as well as how real estate developers are allocating their development projects is tilting where the demand is, which while, obviously nursing homes, senior care is in high demand, so is multifamily. And so you're seeing a lot of assets or a lot of capital that would otherwise go into developing more nursing homes go into developing multifamily because the economics are on their side when that happens. The point here is that you're riding the wave not just of an aging population, but you're also capturing market share from a declining alternative. And home care is growing because it's taking share from a facility-based care, and there's a much stronger tailwind than most people realize. Reason number 2 is that senior care is a business that is both recession-proof as well as has a very high customer lifetime value. And I'll walk through the recession-proof part of it first, because obviously we don't want something ideally that is discretionary where people can cut it whenever there's macroeconomic disruption. When you have a senior that needs ongoing care, you really can't cut that without it disrupting the lives of the loved ones, typically the children of the individual that's aging. And then the other thing is that a lot of home care can be reimbursed, whether it's through Medicare, through Medicaid, through long-term care insurance. Obviously, whenever something is paid by insurance or the government, there can be more red tape around it as a business owner, and sometimes it can present cash flow constraints because insurance or the government likes to take forever to pay you, but it does bring price elasticity down because the end consumer is not the one that's actually paying for it. So that's the recession-resistant piece of it. Now, we'll talk about the lifetime value piece of it. So whenever you are going to calculate the lifetime value of a customer, you have to multiply the average ticket versus the frequency versus the customer longevity. Average ticket in home care is a little bit ambiguous because you're not just hiring like a one-time service. Typically, you're paying by the hour. Let's say, hypothetically, you were paying by the visit. Then you look at frequency. Ongoing care, that can be up to 24/7. And you're rarely going to find a service business out there where the frequency of service is literally around the clock. But even before that's needed, you need a non-medical caregiver to stop in and just help with chores and help with meal prep and making sure that, your medicine is there and all of that. Even those are going to be multiple times a week. And so when you compare this to a home service business, like a landscaping business, well, that's a very high frequency service, relatively speaking. And that would be once a week, right? And, most are going to be even longer than that, maybe once a month at best. Rarely are you going to have the opportunity in a business where it's multiple times a week, and that's the lower end of the frequency frequency, and the higher end of the frequency is literally 24/7. And then we think about customer longevity. A lot of people morbidly think that customer longevity in the senior care business wouldn't be very good for obvious reasons. The reality is that these businesses can still have customer longevity for 5 to 10 years, a number of years at least. Obviously, that's going to depend on the type of home care business that it is, whether you're on the non-medical side of things, when you're treating customers that are not as advanced in their decline, versus on the more complex side of things. Obviously, that may have lower longevity for a number of reasons. But still, when you have a high average ticket, very high frequency, and a customer longevity period of the customer lifespan that's still a number of years, that adds up to an average lifetime value of that customer that is often going to be 6 figures. And that is not common in a service industry that is B2C. And so what that means for you as the business owner on a net basis is that you need to acquire fewer customers to hit the same amount of revenue as you would in a business that has a lower lifetime value. Obviously, that means that you can be more focused on internal operations, less focused on sales, again, on a net basis, and you build very deep relationships with your customers because it is high touch. Number 3 to consider a senior care franchise are the low capital requirements. Most home care franchises have startup costs anywhere from $100K to $250K on the high end. Sometimes you'll see it go a little bit higher than that if it's something that's very specialized and more capital intensive, but these are not typically capital intensive businesses because you don't need expensive equipment, you don't need big trucks, no inventory requirements, no build out of a facility because they're usually run from a home office or a small commercial space. Your biggest startup costs really are your franchise fee, obviously, and working capital, enough to pay insurance, your payroll before you're cash flow positive, plenty of marketing to make sure that you can get the customer flywheel spinning and scale. But it's not as capital intensive when you compare it to a brick and mortar franchise, obviously, which is $300K all the way up into 7 figures. But even other service franchises, non-brick and mortar franchises that may still be in the $200K to $300K ballpark to start, a lot of that investment is going into trucks and equipment, and those are depreciating assets. And all that extends the distance that a dollar has to travel between getting into the top of your P&L to the bottom line of your P&L. And then, from it getting to the bottom line of your P&L to your bank account makes that distance further because you have to factor maintenance CapEx into that whenever you're working with assets that are depreciating. The P&L in a home care business tends to be pretty simple. You have payroll, obviously, your biggest expense. A lot of people in this business. Insurance is expensive. Your marketing, and then you have normal operating costs like any other business does. Typically not cost of goods sold, inventory, not really a factor in this business. No maintenance CapEx, like I mentioned. And so it is not a super capital intensive business, which is a good thing. And so reason number 4 to consider senior care is what I call the referral network mode. Many franchises, particularly service franchises, they rely very heavily on expensive digital marketing. Part of home care's competitive advantage is the referral networks that you can build. And once they're built, they can be very, very lucrative and more challenging for competitors to disrupt. Referrals can be exciting in any business. One of the reasons that home care is specifically oriented around referrals is that it's a very high-touch service. There are a lot of moving parts, a lot of providers and other businesses that are operating with adjacency to the home care business, all of which can be referral partners. That can be anything from hospitals and physicians that are making recommendations to their patients that they go out and get a caregiver. These can be non-medical or medical home care services. Home care businesses, some do both, some do the whole gamut, but a lot specialize in either exclusively non-medical home care or medical on the higher end of complexity. Those two businesses can be great referral partnerships for each other because they refer each other clients as needs change, and that could be great. Nursing homes can be great referral partnerships for home care businesses because a lot of time prospective residents in a nursing home will visit and then decide they want to go the home care route or vice versa, and so they can kick business back and forth with each other. The point is that a steady stream of qualified leads without paying for ads is very possible when you build these referral networks, but obviously when you get into this business, if you're going to get into this business, you have to do a lot of introspection on your part to make sure that you have the skill set and the mindset to go and build your network appropriately. Reason number 5 to consider a senior care franchise is technology. And I understand that's a very broad way to frame this reason. I'll walk through it. And one of my hotter takes and one of my challenges with some discourse in the small business community, people that are looking to buy businesses, is I actually think that there are a lot of particularly young aspiring business owners that overemphasize the need for technology in their own head when it comes to small business ownership. I think a lot of people think that they're going to buy a business from a boomer and install a new CRM and it's going to completely revolutionize the business. Maybe that happens. Maybe it doesn't. I really don't think it does. But I do think that in senior care, technology is a very, very important piece of the puzzle because of all of the moving pieces. And I'll walk through a few of those. But when it comes to senior care franchises, technology is a big piece of what franchises should be providing to their franchisees. And again, this is a lane where technology gives you a significant advantage. Obviously, senior care is a very people-intensive business. Technology will never replace people, unfortunately. Fortunately or unfortunately, depending on how you view it. What it will do is it will make it easier to manage people. It will provide more accountability, more monitoring and oversight. Some senior care franchises actually have security cameras, right? That during onboarding, that's just how they enhance transparency. The business owner can spot check, but also the family members can spot check. Many have GPS-based check-in and check-out systems for caregivers. Many have hourly checklists with medication reminders and meal prep and mobility assistance, so they have real-time documentation. And obviously, this is great for the business owner because it holds their employees accountable without having to manually do so and check up on them. But it's also great for customer service because more transparency for the family. A lot of times customer service in this business isn't directly to the person that's being cared for, but it's a lot of times it's to their family. When you have technological portals for the family where they can look and see what's going on, not only does that enhance the experience from their point of view, but it also doesn't add any extra work on the part of either the manager or the owner who's having to field calls from the family members. The third thing where technology really impacts this business is on recruiting and retention. Because again, in this business, your product is your people in the most literal sense of the word. The quality of the caregivers is everything. Some franchises have specific hiring niches. Some have very specific training platforms that enhances this. It's also very important to have very good background checks and validation systems. Also, you're not managing schedules with spreadsheets when it comes to some senior care franchises that have really good technology, which can enhance both recruiting and retention. And then the fourth thing is obviously scheduling and billing. And so if you have 15 different clients with different needs and 20 different caregivers with different availability and skills, having very good tech platforms that the franchisor is going to furnish you is going to help when it comes to scheduling as well as when it comes to billing on typically a monthly basis, especially if it's being reimbursed by Medicare, Medicaid, or insurance. A lot of them are going to have their own tech platforms that they work with, and you have to really stay on top of them. Otherwise, you can get behind on payments, which is not a good thing because it causes a lot of cash flow constraints in this business. Those are 5 different reasons why I think the senior care franchises represent one of the best opportunities in franchising for 2026. But as always, it's important to be aware of and to weigh all of your options before you pick the right one. And that's exactly what I help people do as a franchise consultant. If you have at least $100,000 of liquid capital to invest and you'd like my help finding the right franchise for you, whether it's senior care or a different industry, click the link below in the description. We can schedule a one-on-one strategy call to get started. And as always, please do like this video, subscribe to this channel, and leave a comment letting me know what franchise you'd like to hear about next.